section 5. So today we will be looking at a past paper question which was on August 2023. It was question 2B. I have linked the past papers in the description below, so you can go ahead and join the group for access to the past paper questions and also to the solutions on those past paper questions. So the question reads, Tobin Limited is appraising an investment project which has a cost of 20 million payable in full at the start of the first year of operation. The project's life is expected to be 4 years, and the forecast sales, the volumes, selling price, variable cost and fixed cost are as follows. So we are given for the first year the sales in units for year 1 all the way to year 4, the selling price per unit in shillings for year 1 all the way to year 4, the variable cost per unit from year 1 all the way to year 4, and the annual fixed costs from year 1 all the way to year 4. Then we are given additional information. Number 1 says the selling price and cost information are in current price terms before applying the selling price information or inflation, not inflation of 5% per year. So we are told that the selling price and cost information are in current price terms. And if they are in current price terms, this means that we'll be applying selling price inflation of 5%. So we'll be including the 5% on each year. Fine. Variable cost inflation of 3.5% per year and fixed cost inflation of 6% per year. That's fine. We'll be able to include that. Tobin Limited pays annual corporation tax of 30%, with the tax liability being settled in the year in which it arises. That's okay. The company can claim tax allowable depreciation on the full initial investment of 20 million on a 25% straight line basis. That's okay. The company's investment project is expected to have 0 residual value at the end of the 4 years. Fine. Tobin Limited has a nominal after-tax cost of capital of 12% and the real after-tax cost of capital of 8%. And then the last point, number 6, the general rate of inflation is expected to be 3.7% per year in the foreseeable future. That's okay. Required, the nominal net present value of Tobin Limited. Fine. Let's go ahead and work that one out. So this is on August 2023, question 2B. August 2023, question 2B. Question 2B. So you can go ahead and download the past paper questions from our group, and to access the group you can check the link in the description below. Now let's start by, the question requires us to calculate the nominal net present value, the nominal net present value, the nominal net present value. So to do that, we will be solving, we'll start by getting the sales. Normally what we usually do, we take the sales, we less the variable cost, less the variable cost, we get the contribution, and then from the contribution we less the fixed cost, we get the cash flow before tax, From there we less tax, and we check for any benefits on which we have, and from there we get the net PV by multiplying the net cash flow with the discounting factors. Now that's exactly what we are going to do. And let's start by getting the sales. So we have the selling price. So we have the year. You can have the year. We have year 1, year 2, year 3, year 4, and year 5. So we have the selling price per unit. Year 1 is 125. Year 2 is 130. Year 3 we have 140. Year 4 we have 120. We actually don't have year 5. Let me go ahead and erase this. We have those 4 years. And then from there, we are told, back at the question, we are told that the selling price and the cost inflation are in current price terms. So all these are in current. They have not been inflated for each of these years. They have not been inflated. They are in current price terms. So the selling price inflation is at 5%. The selling price inflation is at 5%. So let's go ahead and work that one out. Inflated by 5% annually. So inflated by 5% annually. So we have 125, multiply that by 1.05. Good. Next, we have 130, multiply that one by 1.05 power 2. Next, we have 140 times 1.05 power 3, and then we have 120 times 1.05 power 4. Since they're in current price terms for each year. Now let's go ahead and multiply this. We get the actual prices. So 125 multiplied by 1.05, we get 131. Here we get 131.25. Here we get 143.33. Here we'll get 162.07. And lastly, we have 145.86. Now those are the current, or those are the inflated prices. Now to get the sales value, we multiply by the selling price, or the number of units sold. We have the selling price. So the sales, we are given the sales. So these are the sales in use. The first year we have 300,000, 410, 525 and 220. Let's go ahead and include those. We have 300,000. We have 410. We have 525. And lastly, we have 220. So we can go ahead and get the sales value. The sales value. We multiply the selling price by the sales in units. So 131.25 multiplied by 300,000, we get 375,000. The next one we take 410 multiplied by 143.33, we get 58. 765,300. Next we have 525,000 minus 162.07, we get 85. 086,750. Next we multiply to 20,000 with 145.86, we get 32,089,200. Now that's our sales value. Let's go ahead and get the variable cost per unit. The variable cost per unit. The variable cost per unit. So it's not changing. It's remaining constant at 71. We take, we include the inflation. We go ahead and include inflation. It is inflated at 3.5% annually. So we will take 71 multiplied by 1.035. The next year 71 times 1.035 power 2. And next we have 71 times 1.035 power 3. And lastly 71 times 1.035 power 4. 71 times 1.035 power 4. After that, go ahead and multiply. The first one will get the inflated variable cost will be 71 times 1.035, we get 73.49. The next one we get 76.06. Next we have 78.72. Next we have 81.47. That's it. Now to get the total variable cost, we'll go ahead and multiply with the number of units. So the sales in units. Again, we have 300,000. We have 410,000. We have 525,000. And lastly, we have 220,000. Go ahead and multiply that. We get the first one, 73.49 times 300,000. Get the total variable cost. We get 22,047,000. Next one, for 10 times 76, we get 31,184. 600. Next we get 525 times 78, we get 328,000. The last one, we take 81.47 times 220, we get 923,400. 923,400. And that's it. That's our total variable cost. Now we go ahead and get the fixed cost from our question. Let's see. The annual fixed cost is 3 million, that 3.1, 3.2, and 3 million. But from additional information number 1, we are told that the variable cost is inflated by 3.5% per year, and the fixed cost is inflated by 6% every year. So we do the same thing. We take the fixed costs, fixed cost, we take 3 million, 3.1 million, 3.2 million, and 3 million at year 4. Now from there, you can get the inflated by 6%, inflated by 6%. So we will be multiplying. We will be multiplying 3 million multiplied by 1.06 power 1 power 2 all the way to year 4. So the same thing we have been doing in the first one. So we will have 3 million. The first one will be 3.18. So this is what I'm saying. We'll be multiplying 3 million. Multiply that one by 1.06 power 1. The next one will take 3.1 million times 1.06 power 2. Next we'll take 3.2 million times 1.06 power 3. Lastly, we'll take 3 million times 1.06 power 4. We go ahead and get the figures. With this will give us 3.18 million. Next we multiply. This is giving us 3.483 million. 3,483,160. Next one is giving us 3,811,251. And then the last one is giving us 3,787,431. 431. Next, we can work out the depreciation part of it. Not depreciation, but the taxation part of it. We are told Toby Limited pays an annual corporation tax of 30% with a tax liability being settled every year. Fine. The company can claim tax allowable depreciation on the full initial investment of 20 million on a 25% straight line basis. So let's work that one out. We'll take 20 million, multiply that one by 25%. 25%. 20 million times 25%. That one is giving us 5,000. So the tax allowance on depreciation will be 5,000, which is on a straight line, so it will remain 5,000 each year. 5,000, 5,000, 5,000. Next, we go ahead and get the depreciation on this at 30%. So the depreciation, okay, this is already the depreciation tax allowance. Now we go ahead and calculate the benefit they are getting, the benefit at 30%, the tax allowance depreciation benefit, the tax allowance depreciation benefit. This is at 30% because the depreciation rate is 30%. So 30% of 5 million is 1.5 million. 1.5 million on a straight line again, 1.5 million. And lastly, 1.5 million. And that's it. Those are all our workings. We can now go ahead and calculate the net present value. You can go ahead and calculate the net present value. To do that, we'll start with the sales. So we have the year 1, 2, 3, and 4. We start with the sales figure. So our sales figure we had calculated here. So this is our sales figure, 39,375,000 for year 1. We take 39,375,000 for year 2. We saw it to be 58,765. For year 3, we saw it to be 85,086,750. 85,086,750. For year 4, we had 32,089. 32,089,200. We less variable cost. We saw our variable cost here. We had calculated the total variable cost. The first year was 22,047,000. Go ahead and less it here. 22,047,000. For the second year, we had 31,184. 31,184,000. We less. The third year, we take 41,328. We less. The fourth year, we take 17,923. 17,923. We less. And that will be that will give us the contribution. That will give us the contribution. For the first year, we will have 39,375 minus 22,047, giving us 17,328. 17,328. 38,765,000 minus 31,184. or 58. It should be 58,765 minus 31,184. This is giving us 27,580. 27,580,000. Next, 43,758. You can have 43,758, 750. And lastly, 14,165. 800. Now from the contribution, we go ahead and less the fixed cost. Go ahead and less the fixed cost. So the fixed cost for the first year, we had calculated it here. It was 3180. 3180. Less for the second year, 34,83,160. For the third year, 38,11,251. For the last year, 37,87,431. 37,87,431. Let's go ahead and get the cash flows before tax. Cash flows before tax. Cash flows before tax. So we less the two, 17,328,000 minus 31,80,000. This is giving us 14,148. Next, we have 27,580, 700 minus 34,83,160. This is giving us 24,097, 24,097,540. This is positive, not negative. And next, we have 43,758 minus 38,11,251. This is giving us 39,947. 499. And lastly, we have 14,165, 800 minus 37,87, 431. This is giving us 10,378. 10,378. 369. Less tax at 30%. We less tax at 30%. We less tax at 30%. So if I take 14,148,000, 14,148 times 30%, I get 44,400. So we less 44,400. I have multiplied the next one, 24,097,540 multiplied by 30%, we get 72,29. 29,262. The next one, we take 39,947,499 multiplied by 30%. We get 11,984. 11,984. 250. The last one we take 10,378, 369 multiplied by 30%, we get 31, 3,113,511. And that's it. We get we add back the tax depreciation allowance benefit. We add back tax depreciation benefit. It was 1.5 we had calculated. 1.5, 1.5, 1.5, 1.5. Next, you can go ahead and calculate the cash flows. The after-tax cash flows, we go ahead and add 148,000 minus 44,400 plus 1.5. This is giving us 11,403,600. 11,403,600. Next, we do the same thing. It's giving us 18,368,700. 18,368,278. We do that for the year 3. It's giving us 29,463,249. Lastly, we do that for year 4. It's giving us 8,764,858. And that's it. So that is our after-tax cash flows. After-tax cash flows. That will give us our after-tax cash flows. Now from there, we can go ahead and get the discounting factor at 12%. Discounting factor, it's at 12%, because we have told that Toblin Limited has a nominal after-tax cost of capital of 12%, so you'll be using at 12%. So at we get the tables. So 12% year 1, we have 0.8929, 0.8929. 12% year 2, we have 0.7972, 0.7972. 12% year 3, we have 0.7118, 0.7118. And lastly, 12% year 4, we have 0.6355, 0.6355. And that's it. From there, we can get the present value of the cash flows, the present values. So we multiply 0.8929, 0.8929, multiply that one by 11,403,600, 11,403,600. It's giving us 10,182, 10,182.274.44. 10,182.274.44. I do that for each and every one of these, multiplying it by the discounting factor, multiplying the cash flows by the discounting factor. Let me pause the video and we'll see you after I've multiplied each of these. So I have multiplied We have multiplied all the discounting factors and the cash flows, giving us our present values. Now we go ahead and add all these present value, the sum of present values I have also added. It is giving me 51, 367, 476.56. This is all the sum of all the present values. I go ahead and less the initial outlay, less initial outlay. We are given the initial outlay as 20 million. We less 20 million, and we have the net present value being 31, 367, 473.56. And that's it. That's what was expected in that question. And in the next question, we'll still look at more past paper questions on advanced capital budgeting. And that concludes our lesson for today. Thank you.